you think that the weakness that we've been seeing in EM, emerging market FX, doesn't really have to do as much with U.S. rates and higher for longer. Why is that?
I think it's a combination of things. Of course, there's a repricing with the dollar and with interest rates in the U.S., but also there are these Middle East geopolitical tensions that are creating this risk-off environment. And so it's a combination of things that are leading to this kind of a dollar move. And at this point, I do think that a lot of the growth differentials and the interest rate differentials, which are the key drivers of the dollar versus other currency pairs, that I feel like they look like at their peak, right? Growth is picking up in rest of the world. Interest rate differentials at this point of the cycle may be pricing in, the maximum spread in favor of the dollar. So I do think that, this is a reaction to a combination of things, but I do believe that this is going to be idiosyncratic because it's a heterogeneous group of currencies and countries. And also this time is different from past Fed pricing of interest rates given the fundamentals in the emerging market universe at this point of their market and economic cycle.
All right, so overall, what you're saying, Jitania, is EMFX is probably about as weak as it's going to get, and tactically, this is probably a good entry point. But we know your point that look, you can't all sort of lump them in the same basket, right? They're very, very different and distinct. Where do you see best value?
Yeah, so I really think that, some of the Latin American and emerging European and even countries like India, for example, they're the real rates, which are, the drivers in the short term. The real rates are pretty much in favor of EMFX. Emerging markets were way preemptive in their hiking cycle. Even on the inflation side, the inflation's turning down, and they have been cutting rates till the more recent episode. So I do think that they have been, following their own economic trajectory independent of the U.S. Compared to, say, a taper tantrum in 2013. They have much better fiscal current account balances. Again, on aggregate, of course, there are outliers, much better in terms of monetary orthodoxy and monetary management, much better FX reserves even to defend currencies if needed. So I do think that different pockets where real rates especially are high look interesting. And India just looks interesting with a stable macro situation. Some of the Latin American currencies are yielding real rates in excess of 5-6%, which is, like the Mexican currency, etc. The real rate advantage is pretty much in favor of the currency. So I would be less concerned given the fundamentals are much better than the past.